In 2008, my uncle lost his job. He had $47,000 sitting in his savings account. He thought he was being responsible. He thought he was playing it safe. 5 years later, that same $47,000 could only buy what $41,000 used to buy. He didn't spend a single dollar, but he lost $6,000 in purchasing power. And his bank? They sent him a congratulatory email for being a loyal saver. Here's the truth nobody wants to admit. Your bank is not your friend. It's a business. And every single day, that business is designed to extract value from you in ways so subtle you don't even notice. Today, I'm breaking down 10 bank secrets that keep everyday people poor while making the system incredibly rich. And secret number 7, it's the one that changed how I think about money forever. Let's dive in.
Secret number 1. Your savings account is a losing investment. Banks love savers, they really do. They'll show you commercials with happy families watching their balance grow. They'll praise your discipline. But here's what they won't tell you. The average savings account in America pays about 0.46% interest per year. Some of the high-yield accounts might give you 4% if you're lucky. Meanwhile, inflation over the last decade has averaged between 2% and 8% depending on the year. Let's do the math. If you have $10,000 sitting in a standard savings account earning 0.5%, after 1 year, you'll have $10,046. Congratulations. But if inflation is running at 3%, the stuff you could buy with that $10,000 last year now costs $10,300. You gained $46, but you lost $300 in purchasing power. Your balance went up. Your wealth went down. Banks know this. They're counting on you not knowing it. Because while your money loses value, they're using it to make real returns. Which brings me to secret number 2.
Your deposits become their profit machine. When you deposit $1,000 into your checking account, you probably imagine it sitting in a vault somewhere with your name on it. That's not what happens. Banks are required to keep only a small fraction of deposits on hand. The rest? They lend it out immediately. Your $1,000 becomes someone's car loan at 7% interest, someone's mortgage at 6.5%, someone's credit card balance at 22%. You earn 0.5%. They earn 7%, 10%, sometimes 20%. You're providing the capital, they're taking the profit. Now, this isn't illegal. This is literally how fractional reserve banking works. But here's the kicker. You take on the risk of having your money in the system, and they take almost all the reward. And it gets even more interesting when you realize banks don't just move your money around, they actually create new money, which is secret number 3.
Banks create money out of thin air. This one blows people's minds. When a bank approves a $300,000 mortgage, they don't go into a vault and pull out $300,000 in cash. They don't transfer it from someone else's account. They create new money, digitally, out of thin air. It's called credit creation, and it's completely legal. When a loan is issued, new money enters the economy. When the loan is paid back, that money disappears. This is why the money supply keeps expanding. This is why asset prices keep rising. And this is why holding cash for decades is financial suicide.
The system is designed to reward people who own assets, real estate, stocks, businesses, and punish people who hold cash. Banks understand this deeply. That's why their executives don't keep their wealth in savings accounts. They keep it in assets, and they use other people's deposits to acquire more, which leads directly into secret number 4.
Credit cards are designed to keep you paying forever. Credit cards look friendly, don't they? Cashback, airline miles, points, rewards programs. Spend $500 in the first 3 months and get $200 back. But here's what the fine print doesn't emphasize. If you carry a balance, the average credit card charges 19 to 24% annual interest, and it compounds monthly. Let's say you have a $5,000 balance, and you're making minimum payments of $150 a month. Sounds responsible, right? At 22% interest, it will take you over 5 years to pay that off, and you'll pay nearly $4,000 in interest alone.
Your $5,000 debt just cost you $9,000. But here's the truly insidious part. Minimum payments are mathematically designed to keep the debt alive as long as possible. They're structured so you feel like you're making progress, but the balance barely moves. Banks don't want you debt-free. They want you comfortable with carrying debt, because that's where the real profit is. And while regular people drown in 22% interest, the wealthy play a completely different game. Which brings me to secret number 5.
The wealthy borrow to build. You borrow to consume. Most people borrow money to buy things that lose value. A new car, a vacation, a bigger TV, furniture, lifestyle upgrades. These are called liabilities. They cost you money over time. Wealthy people? They borrow money to buy assets, real estate that generates rental income, businesses that produce cash flow, investments that appreciate in value. Same tool, completely different outcome. But here's where it gets even more unfair. The system rewards people who already have money. If you walk into a bank with a $50,000 net worth and ask for a $20,000 loan, you're going to pay 12% interest or more. You're seen as risky. If you walk in with a $5 million net worth and ask for the same loan, you might pay 4% or less. Why? Because you have collateral. You have assets. The less money you have, the more expensive it is to borrow money. And that single rule is secret number 6.
Rich clients get cheaper money. Let me give you a real example. A friend of mine is a real estate investor. He has a portfolio worth about $3 million. When he wanted to buy another property, the bank offered him a loan at 3.8% interest. Another friend, a teacher with $40,000 in savings, wanted to buy her first home. Same bank. Her rate, 6.2%. Why the difference? Risk assessment. Banks charge higher rates to people with less collateral, people with fewer assets, people who, statistically, are more likely to default. But think about what this means in practice. The person who already has money gets access to cheap capital. The person trying to build wealth has to pay a premium for the same access. Money flows toward people who already have it. And this principle shows up most powerfully in the biggest purchase most people ever make, which is secret number 7, the one that changed everything for me.
Secret number 7. Mortgages make banks generationally wealthy. Here's the big one, the secret that woke me up. Let's say you buy a $400,000 house with a 30-year mortgage at 7% interest. Your monthly payment is about $2,660. Over 30 years, you'll pay roughly $958,000. You borrowed $400,000, you're paying back nearly $1 million. Now, does that mean buying a house is a bad idea? Not necessarily. Real estate can build wealth through appreciation and equity. But here's what banks don't emphasize. They get paid first. Before you see any appreciation, before you build equity, before you experience financial freedom. For the first 10 years of that mortgage, most of your payment goes toward interest, not principal. You're barely making a dent in what you owe. Let me show you what this looks like. In year 1 of a $400,000 mortgage at 7%, you'll pay about $27,800 total. But only $6,000 goes to principal. The other $21,800, pure interest, straight to the bank. And if you sell the house early, which most Americans do, the bank has already extracted the majority of the profit, while you're left with minimal equity. Understanding the true cost of long-term interest is the difference between building wealth and staying trapped. And this connects directly to secret number 8.
Fees are a silent profit engine. Overdraft fees, monthly maintenance fees, ATM fees, wire transfer fees, foreign transaction fees, paper statement fees. Individually, they seem small. $3 here, $12 there, $35 for an overdraft. But banks in the United States collect over $30 billion per year in overdraft fees alone. Let me put that in perspective. If you're charged just one $35 overdraft fee per month, which millions of people are, that's $420 per year. Over 20 years, that's $8,400 just in overdraft fees. Now multiply that across maintenance fees, ATM fees, and everything else. Most people never calculate how much they've paid to banks over their lifetime, but the banks have, and they've built an entire profit model around it. And there's a reason these fee structures are so complicated, which brings me to secret number 9.
Complexity is profitable. Have you ever tried to read a bank's terms and conditions? Pages and pages of legal jargon, clauses buried in fine print, interest rate formulas that require a finance degree to understand. This isn't an accident. Complexity creates dependence. The less you understand, the more likely you are to accept bad terms. The more likely you are to miss hidden fees. The more likely you are to stay loyal to a system that doesn't serve you. Banks don't profit from educated customers. They profit from confused ones. Financial simplicity is not promoted because complexity is profitable. And that's why financial education is almost never taught in schools, which is the final secret.
Secret number 10, your financial ignorance is by design. Think about what you learned in school. Algebra, Shakespeare, the periodic table, mitochondria is the powerhouse of the cell. But how many of you graduated high school knowing how compound interest really works, how credit card debt spirals, how a mortgage is structured, how investing actually builds wealth? Almost no one. And it's not because teachers don't care. It's because the system doesn't prioritize it. Financial education is left to individuals. Those who seek it gain power. Those who don't remain dependent on the system. And the system prefers dependence. The banks aren't going to teach you how to beat them. That's your job.
The banking system isn't broken. It's working exactly as designed. But once you understand the rules, you can play the game differently. You don't need to hate banks. You don't need to fear them. You just need to stop expecting them to prioritize your wealth over their profit. Learn how money really works. Question the default advice. Build assets, not just savings. Understand the true cost of debt. And most importantly, stop outsourcing your financial education. Because the moment you understand money, money stops controlling you. If this opened your eyes, subscribe to Money Simplified. We break down wealth, investing, and personal finance without the nonsense. See you in the next one.